Assalamualaikum. Today, I would like to present about company background and organizational context. The company that we choose is Apollo and Oriental. So, Apollo Food Holdings was founded in 1994 and has 489 total employees. The product that they produce is chocolate confectionery and layer cakes based in Malaysia. Apollo products are distributed in Malaysia and other overseas markets, which is Singapore, Indonesia, Thailand, and more. For organizational context, have internal and external issues. For internal issues is liquidity risks and operational risks. For external issues is foreign exchange risk and market competition. For the second industry is Oriental food industry. Sendian Berhad is one of the well-known snack food produced in Malaysia. The main product that they produce is Jacob potato chips. Organizational context for internal issues is taste balance to meet the needs of multicultural group, and work stress and employee well-being at office checker. For external issues is local competitor and economic conditions where inflations and consumer purchasing power.
Based on the calculation, Apollo Holdings demonstrates stronger liquidity than Oriental Industries Holdings with significantly higher ratio, which is 11.14 to 20.33. Asset ratio that is 10 to 0.97, indicating the short-term solvency. However, Apollo Food excessively high liquidity ratios may indicate the use of assets, which could limit the profitabilities. Apollo Foods also collect payments faster, reducing its day in receivable from 52 to 39 days, while Oriental Food increased from 60 to 69 days, reflecting slower collections. Additionally, Apollo Food maintains better inventory management with lowest days in inventory, which is 52 days, while Oriental Food 62 days, and higher inventory turnover, that is 7.16 with 0.0. Internally, Oriental Food struggle with receivable and inventory management, which impact cash flow and operational efficiency. Externally, both companies may face supply chain disruptions and economic pressures such as inflation and shifting consumer demand, which could affect their liquidity and operations. While Apollo Food holds a clear financial advantage, it should focus on optimizing asset utilization, whereas Oriental needs to address its external inefficiencies to improve the performance. Overall, based on the liquidity, it shows that Apollo Food Holdings Berhad has a stronger liquidity and better operational efficiency than Oriental Food Industries Holdings Berhad because it has a higher current ratio and asset test ratio, faster collection receivable, and also better inventory turnover for the 3 years continuously.
Based on the table, Apollo Food Holdings Berhad is the better company for all the ratio, and here's why. First of all, on return on asset, Apollo achieved a significant improvement in ROA, reaching in 18.52% in 2023, much higher than Oriental Food, which is 13.21% in the same year. This indicates that Apollo is more effective in using its asset to generate profit compared to Oriental. On the second ratio, which is operating profit margin, Apollo make a strong rebound to 18.44% in 2023, while Oriental Food dropped to 10.58%. Apollo demonstrated a better operational efficiency and profitability from its core business. For the third ratio, which is total asset turnover, Apollo grew up in 2023 after dropping in the last past year, while Oriental are much higher than them. However, Apollo's fixed asset managed to balance the gap after achieve a strong profitability while steadily improve their utilization. The last ratio for this question is fixed asset turnover. Apollo has outperformed in 2023 with 3.18 compared to Oriental Food 2.75. This indicates that Apollo used its fixed asset to their maximum value to generate more profit. There are two main ratios on how the organization is financing its asset. First of all, debt ratio. Apollo showed a decreasing trend from 9.20% in 2021 to 6.81% in 2023. This indicating that Apollo reduced their reliance on debt to finance its asset, while Oriental Food Industry fluctuates slightly, decreasing from 21.60% in 2021 to 19.75%, suggesting they are moderately improved to its financial management.
Secondly, we will talk about time interest earned. Time interest earned formula is operating profits we divide with interest expense. For 3 years, Oriental get a higher ratio than Apollo Food. For example, for 2023, Oriental Food operating income is 256.04 times the annual interest expense and higher than Apollo Holding that is get 28.25 times due to its relatively higher operating profit. This is showing that Oriental Food are more better at covering its interest expense with its earning before interest and taxes. We will move to the question number 4, that is, are the managers generating a good return on equity? We can use 3 approaches to solve this question. First of all, we can use return on equity, that is, the measure of a company's annual return on net income divided by the total common equity of its total shareholders' equity is expressed as a percentage. For 3 years, both companies are efficiently using its equity. But in 2023, Apollo get more higher return on equity, that is 13.26%, than Oriental that is only get 8.27%. This shows that Apollo are more successful in generating profit internally. Secondly, we can use market value ratio. Market value ratio has 2 ways to solve. First, we can use price or earning ratio. Price or earning ratio is the ratio between a company's stock price and earning per share. For 3 years, Apollo Food Holding has much better price earning ratio than Oriental Food, despite both companies has been decreasing and increasing in 3 years. For example, in 2023, Apollo are getting 11.26 times compared to Oriental, who only get 0.83 times. This shows that investors are willing to pay more for Apollo for every ringgit Malaysia of earning per share compared to Oriental food industry. Other than that, we can use price or book ratio. Price or book ratio is to compare a firm's market capitalization to its book value and locate undervalued companies. This ratio calculated by dividing the company market price per share and equity book value per share. A ratio greater than 1 indicates that the shares are more valuable than what shareholders originally paid. In 3 years, Apollo are much better than Oriental. This is because in 3 years, Apollo increasing while Oriental are decreasing in 2022 and increasing in 2023. For example, in 2023, Apollo ratio are 2.73 times, that is much higher than Oriental that only get 1.12 times. Overall, Apollo Food stock is overvalued or the market expects significant. Lastly, we can use economic value added. Economic value added is the incremental difference in the rate of return over a company cost of capital and then multiplication it with total asset. In 3 years, Oriental are more better than Apollo, even though in 2023, Apollo are more higher than Oriental. But in 2022 and 2023, Oriental are more higher than Apollo. For example, in 2022, Apollo are getting RM 107,361,826.4, that is much lower than Oriental that is get RM 3757,426,928. This explains that Oriental is generating return in excess of the cost of its capital, which is sign of value creation for shareholders.
Apollo Food Holdings Berhad, which produce Apollo Wafer, Layer Cake and Swiss roll products, shows a good financial health over years. This company seems to be more stable than Oriental Food Industries. Based on the data given, Apollo Food Holdings Berhad shows the revenue is growing by 10% annually. This situation shows that the company will have a good future in food industries and will be a great potential for investors to invest in this company.